In this edition of RIN TV, Aetna acquires Coventry. ISO's Stephen Clarke on insurers managing magnified risks in a slow economy. Jacobson and Ward discuss positive hiring trends in the industry. Stephen Clarke takes a historic look at U.S. hurricanes. And the 20th anniversary of Andrew. All this and more. You're watching World Risk and Insurance News on RIN TV. Hello, I'm Marisa Christian, and here's what's happening in the world of insurance. Aetna is acquiring Coventry Healthcare. In a deal said to be worth $7.3 billion, Aetna will add 4 million medical members and bolster its Medicaid enrollment by some 1.5 million members. All this just months before millions of uninsured Americans become eligible for coverage as the country's new healthcare overhaul takes effect. In part one of my discussion with Stephen Clarke, Vice President of ISO's Commercial Property Division, we discussed how the struggling economy was affecting risk. We pick up our discussion looking at how commercial carriers are coping with magnifying risks. What does all of this mean for commercial insurance carriers?
The risk of loss is going up during the current economic crisis, be it having the supply chain extended out because certain suppliers maybe that you used to use have gone out of business. It's changing the risk. As we're looking at it, the risk is changing.
What can insurers do to mitigate these risks?
Going back right to policy inception and application process and making sure that you understand the risk that you're going to be assuming. Looking at premium audit, that's one place that's easy to function on, but easy also to kind of ignore. And there are various tools that are available from an analytics perspective to help you not only price the policy, various modeling techniques and other analytic tools, but also when the claim comes up to make sure that you're not paying claims that shouldn't be paid or that you're paying appropriate amounts. The flip side of that also is that while analytics and information technology tools can certainly go a long way to helping in this environment, it's important that you don't lose sight of what it is that you're selling here. It's not a commodity product so much as it is a relationship.
That's great advice. Stephen Clarke, thank you for joining us.
Thank you.
If you'd like to see more of my discussion with Stephen Clarke, visit our on-demand library. According to its mid-year labor market study, the Jacobson and Ward groups report more than 50% of insurance companies polled expect to increase staff. Perhaps more encouraging, more than 75% anticipate revenue growth in the coming year. In a recent webcast, executives from Jacobson and Ward ran through the results. Here are highlights of their presentation.
The employment situation in the industry continues to improve, and the current rate stands at 4.6%. You can see that since the official end of the recession in 2009, the insurance industry's employment situation has recovered more significantly and more steadily than the general economy, reflecting the relatively less volatile and less cyclical nature of the industry.
The percentage of companies that anticipate increasing staff is now at its highest at just about 54% of companies. You can also see that there are still a fair amount of companies, about 15%, that are anticipating staff reductions, but it has come down quite a bit over the last 6-month period. In general, it's a very positive trend line. As many of you are aware of, the rebound, particularly in the commercial markets, is largely linked to this growth in both expectations for staff and expenses.
If the industry follows through with its plans, we will see a 1% increase in industry employment during the next 12 months, creating new jobs. So the total benchmark, both property and casualty and life and health, will increase 1%. In the life and health industry, we're expecting a 2.6% increase in employment, while the property and casualty industry will lag, but will increase 0.9%. Specialists in both personal lines and commercial lines are expecting to grow faster than those companies that do both property and casualty, both personal lines and commercial lines equally.
For more on the Jacobson Ward labor study, visit our on-demand library. In a new report, Stephen Clarke and Company identified the U.S. hurricanes that would likely cause $10 billion or more in insured losses if they were to happen today. The firm examined nearly 180 hurricanes that have hit the U.S. since 1900. 28 would have topped $10 billion in losses today, thanks to the number and cost of buildings that would now be in harm's way. Topping the list, the 1926 Great Miami Hurricane with an estimated $125 billion in losses, followed by the 1928 Okeechobee Hurricane, the Galveston Storm of 1900, and 2 Florida storms, the Fort Lauderdale Hurricane in '47 and Hurricane Andrew in 1992. Well, it's been 20 years since Hurricane Andrew devastated Florida. At that time, it was the largest loss to hit the industry, and it remains the third most expensive after Hurricane Katrina and the Tohoku earthquake and tsunami. Munich Re marked the anniversary with a video that explores how Andrew changed the industry. It's a RIN TV recommended view. Visit our on-demand library for more information and links to this informative look back. Well, that's our program. I'm Marisa Christian. Join us next time for more world risk and insurance news on RIN TV.